Hey everyone, welcome back to Corporate Decoder, the place where we get to peek behind the curtain of big business. And today we're diving into Supermicro Computer's latest financial report, which is a bit of a mixed bag, a roller coaster if you will. Before we jump in, if you enjoy getting the real scoop on companies without all the jargon, make sure you hit that subscribe button and become part of our growing community. We also have a fantastic Discord where we chat about these filings and more linked right in the description below, so join the fun there. So this report covers the first quarter of 2026, which is the 3 months ending the 30th of September 2025. Let us start by looking at their financial health at a glance on their balance sheet. As of the end of September 2025, Supermicro had total assets of about $14.4 billion. That is up a bit from $14 billion at the end of June 2025. This increase is mainly driven by their inventory, which jumped up considerably. Inventory shot up from $4.7 billion to over $5.7 billion in just 3 months. That is a big increase, and while it might mean they are getting ready for more sales, it also means tying up a lot of cash. On the flip side, their liabilities are also significant, especially their convertible notes, which stand at nearly $4.7 billion. These are basically loans that can be turned into stock later. Now let's talk about how much money they actually made and spent. Net sales for the 3 months ending the 30th of September 2025 were around $5 billion. This is down from about $5.9 billion in the same period last year. That is a drop of about 15.5%. Their gross profit, which is the money left after paying for the cost of what they sold, also took a hit. It fell from nearly $776 million in 2024 to about $467 million in 2025. That is a drop of almost 40%. This means their gross margin, the percentage of revenue left, after direct costs went from 13.1% down to 9.3%. That is a significant squeeze. On the expense side, research and development jumped up by over 31%, reaching $173 million. This suggests they are investing heavily in new products, which is often a good sign for future growth, but it also eats into profits right now. All of this led to their income from operations dropping sharply. It went from over $509 million in 2024 to just $182 million in 2025. And that filtered down to their bottom line net income for the quarter was $168 million compared to $424 million in the previous year. That is a more than 60% drop. This translates to diluted earnings per S-share of just 26 cents for the latest quarter, down from 67 cents a year ago. So anyone holding stock might feel that pinch. The company explains that the sales drop was mainly because some big orders came in right at the very end of September, so they could not ship them in time for this quarter. They also mentioned competitive pricing and a change in the types of products they sold impacting the numbers. Regionally, the biggest hit was in the United States, where sales dropped by over 56%. This is a massive decline and suggests that even though Asia and Europe saw growth, the US market is really struggling for them right now. Their cost of sales also went down, but not as much as their revenue, which is why gross profit and margin suffered. They spent less on materials and manufacturing, but not enough to offset the lower sales. That big jump in research and development expenses is partly due to more stock-based compensation and higher salaries, as they seem to be expanding their team. Interestingly, their sales and marketing expenses went down quite a bit. This was largely because they received significant reimbursements for marketing efforts from their business partners, which helped offset costs. Salaries and stock-based compensation in this area also went up though. General and administrative expenses saw a slight decrease, mainly due to lower audit and tax fees compared to the previous year when there were extra costs related to some reporting delays. However, consulting fees and employee costs, including salaries and stock-based compensation, continued to rise here too. Now, for something interesting, their other income net jumped from just $7.2 million to over $51 million. This was a big boost, and it came mainly from higher interest income on their cash deposits and gains from investments. Their interest expense did go up quite a bit, from $17.4 million to nearly $25 million. This is likely due to the new convertible notes they have issued, which carry interest costs. The income tax provision decreased, which is a direct result of their lower overall income. Looking at their cash flow, the company used a staggering $917 million in operating activities during this quarter. This is a huge swing from the $408 million they generated in the same period last year. A big reason for this is a massive increase in their inventory assets. They essentially spent over $1 billion more on inventory this quarter compared to last year. This is often a sign that they are preparing for future sales, or that some inventory is not moving as quickly as planned. Their investing activities show they spent about $32 million on property, plant, and equipment. This means they are still investing in their physical assets like buildings and machinery. In financing activities, they used about $18 million. This was mostly due to paying for taxes related to stock awards, which went up significantly. Regarding their financial flexibility, they mentioned having about $4.2 billion in cash and cash equivalents at the end of September, which is down from $5.2 billion at the end of June. They seem confident this cash plus their credit lines will be enough to cover their obligations for the next year. Now, for something that always gets our attention, the report flags material weaknesses in their internal control over financial reporting. This means they have identified significant issues in how they track and report their finances. Specifically, they mention problems with their IT controls for financial systems, segregation of duties, meaning ensuring no single person has too much power over financial processes, issues with the completeness and accuracy of financial information, and difficulties in tracking new related party transactions. They say they have made progress in fixing these problems, especially with their enterprise resource planning system and employee training, but they admit these material weaknesses are still there and they need more time to fully fix them and prove the fixes are working. This is a concern for investors as it can lead to errors in financial reporting. Looking at their equity section, you can see the impact of stock options and restricted stock units being exercised and released. Their total stockholders' equity at the end of September was about $6.5 billion, which is up from $6.3 billion in June. This growth is mainly from stock-based compensation and retained earnings from past profits. Now, for our take on Supermicro Computer, this report paints a picture of a company in transition. They are clearly investing heavily in the future, especially in research and development, and that is a positive sign for long-term innovation, especially in the hot AI and data center markets they are targeting. However, the drop in sales revenue and profitability this quarter is a big concern. The explanation about late orders sounds plausible, but the sharp decrease in gross margin is more worrying. It suggests intense price competition or rising costs that are hard to pass on. The material weaknesses in their internal controls are also a red flag. While they are working on fixing them, it shows a potential for financial reporting errors which can erode investor confidence. The increased inventory levels despite lower sales could also mean they have accumulated stock that isn't selling as fast as they expected, or they are stocking up for an anticipated surge. The significant increase in cash and cash equivalents from their convertible note offerings is what is keeping them liquid for now, and the jump in other income thanks to interest and investment gains helped soften the blow of lower operating profits. But the core business sales and profitability seem to be under pressure. So what is the direction here? Supermicro seems to be betting on a big AI boom to drive future growth, and their investment in R&D suggests they think they have the products to capture that market. However, they need to navigate increased competition, manage their costs effectively, and most importantly, fix those internal control issues to regain investor trust. The next few quarters will be crucial to see if they can turn this ship around or if this current downturn is a sign of deeper problems. Alright, that is our breakdown of Supermicro Computer's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.